China has ramped up its economic rivalry with the United States, now taking direct aim at the US dollar. In recent months, Chinese financial institutions have significantly increased their short positions against the American currency, betting on its decline. The strategy involves complex financial instruments, particularly foreign exchange swaps, allowing these banks to short the dollar effectively. Through these swaps, Chinese institutions exchange yuan for dollars at a set rate. If the dollar depreciates by the end of the contract, the American counterpart owes more yuan, benefiting the Chinese bank. These activities have seen substantial growth, with state-run Chinese banks reportedly amassing more than $100 billion in short positions by 2024. The tactic is part of broader efforts to stabilize the yuan without exhausting China's foreign reserves. China's currency strategy is being driven by mounting pressure on the yuan, weakened by both the Federal Reserve's hawkish policies and a cooling Chinese economy. By engaging in these swaps, Chinese banks have secured returns during periods of market volatility, with some traders reaping returns of up to 6%. Beyond foreign exchange swaps, Chinese banks are reportedly preparing to sell off US dollars in exchange for yuan, part of a broader intervention to support their currency. However, despite these efforts, the yuan experienced its most significant annual decline against the dollar in decades, highlighting the economic challenges China faces. At the center of this strategy is China's central bank, aiming to defend the yuan against a stronger dollar and a slowing domestic economy. By exchanging yuan for dollars, Chinese banks reduce the yuan in circulation, helping to stabilize its value. Despite the dollar's rise in mid-2024, exacerbated by capital outflows and investor withdrawals, Beijing remains steadfast in its economic goals. The strategy carries risks. If the US dollar continues to strengthen, Chinese financial institutions could face steep losses, estimated at between $5 billion and $16 billion so far. President Xi Jinping is at the forefront of these financial reforms, with a personal mandate to develop world-class investment banks capable of rivaling those in the United States. This ambition is part of a larger goal to reshape the global financial landscape and reduce China's reliance on US markets. As the US imposes trade barriers and encourages companies to diversify away from Chinese supply chains, Xi's government has launched an initiative to challenge the Western-led financial system, widening the geopolitical and economic divide between the two nations. What was once a deeply integrated economic relationship has become more adversarial, with global financial markets likely to be reshaped by this high-stakes competition. China's efforts to reduce reliance on the US dollar, often referred to as de-dollarization, reflect a strategic response to geopolitical tensions and economic diversification. A key part of this strategy has been the increased use of the renminbi, RMB, in cross-border transactions. By March 2024, the RMB accounted for 52.9% of China's cross-border payments, surpassing the US dollar's 42.8%. This marks a significant shift from 2010, when the RMB was used in less than 1% of such transactions. Countries like Brazil and Argentina have also begun settling trade in RMB. China's de-dollarization strategy includes aggressively reducing its holdings in US Treasury bonds. In the first quarter of 2024, China sold $53.3 billion of US debt, contributing to an estimated $300 billion in total sales since 2021. This move aims to support the yuan, which is weakened against the dollar. Simultaneously, China has increased its gold reserves, now accounting for 4.9% of its total holdings, the highest level since 2015. This diversification away from the US dollar aligns with China's broader strategy to assert financial sovereignty and reduce exposure to dollar volatility. China's de-dollarization efforts are also closely linked to its involvement in BRICS, Brazil, Russia, India, China, and South Africa, a bloc that now represents a larger share of global GDP than the G7. BRICS has advocated for greater use of local currencies in trade and finance, a stance that gained traction after 2022 sanctions on Russia restricted its access to dollar-denominated markets. BRICS countries are exploring alternatives like precious metals and commodity-backed currencies to challenge the dollar's global dominance. The global trend toward de-dollarization is accelerating, driven by economic and geopolitical factors, particularly among nations in the global south. This movement seeks to diminish the US dollar's dominance in international trade and finance due to its significant geopolitical influence and vulnerability to sanctions. A key driver is the strategic shift toward using local currencies for cross-border transactions, supported by new financial infrastructures like blockchain-based payment systems being developed by BRICS. The role of the US dollar as the world's primary reserve currency is also changing. The share of global central bank reserves held in dollars has dropped from 71% in 1999 to 59% in 2024. Meanwhile, non-traditional currencies like the Chinese yuan are rising in global reserves, reflecting a diversification strategy by central banks. Countries are increasingly turning to gold and other assets to reduce dependence on the US dollar. The geopolitical use of the US dollar, especially in the form of sanctions against countries like Russia and Iran, has prompted these and other nations to seek alternatives. This response is part of a broader effort to insulate their economies from US policy moves.